All right, let's take a look at the National Life FlexLife. Now, I put 2019 FlexLife because when you go onto the illustration software, that is exactly what it says. All right, but it's just FlexLife. All right, if you most of y'all remember the FlexLife 1, FlexLife 2, this one's just straight up FlexLife. So, like I said, if you have questions, type it into the chat box. I'll try to answer as I go. If not, I'll answer at the end. Or just wait till the end and we'll open it up a little bit. But all right, let me get out of this. Okay, FlexLife, here we go. So just like Rodolfo said, we've kind of seen this over and over. This is our bread and butter. This is what we try to push. With the tax-free retirement, living benefits. But Lupe brought up a great point. At the end of the day, you want to walk away with something with every client. So that's why we're trying to show you all these different products and all their specs, so that way you have a better understanding of what you'll use them for. So like I said, terminal illness, chronic illness, critical injury. National Life came out with the living benefits. They are the kings of living benefits. They've got it on their IUL, of course, right? So issue age is 18 to 85, minimum premium $25, minimum death benefits $50K. The original FlexLife 2 was $25, now this one's $50 as the minimum. Okay, so keep that in mind. Easy underwriting, up to 2 million, 18 to 50, up to 1 million, 51 to 60, up to $250,000, 61 to 65. Anything above 65 is going to be full underwriting. Now, notice I've made a little annotation here. As of right now, with COVID-19, 18 to 50s up to 3 million, no medical. Okay. Now, will that stay? Maybe, maybe not. I have no idea. But that's what the guidelines are right now, up to 3 million. Okay, 51 to 60, 61 to 65, and anything above 65 follows this same guidelines. But 18 to 50, as of right now, is 3 million. Okay. A few riders that are most popular, most common. There's quite a few riders, but we're just going to go over these three. The first one is the additional protection benefit rider. This provides extra benefit, extra death benefit that is generally cheaper than the coverage. Than the cost of the base coverage, but it's not commissionable. Basically, they're going to add, if I want $500,000, but I can't afford a permanent $500,000, I might get 250 permanent and 250 additional protection benefit rider. All I do as the client is pay for the cost to have that extra coverage. That's it. I'm not paying any premium handling charges. I'm not paying any indexing handling charges. It is just the cost of insurance. That's all they're adding to my policy. So instead of me paying for a full $500,000, I'm paying for 250 permanent and then 250 additional protection benefit rider. I can get rid of it at any time, but once I get rid of it, I can't get it back. Okay, but as an agent, it's not commissionable. Okay, but it does allow them to get more coverage at a cheaper cost. Another popular one is the child's term rider. Very similar to American Nationals, but this one is from 15 days to 16 years, not 18 like American National. Coverage expires on age 25. You can kind of see the conversions there. 31 days within 31 days of insured's death, within 31 days of child's marriage, within 31 days of policy anniversary after child's 25th birthday. I know that's a lot, but there's quite a couple of different baselines on how long they have to convert. They can go 5,000 to 225,000 if the child or the parent wants to convert that child term rider. I didn't put this in there, but if they want to convert the child term rider to a permanent policy for that child, they can get up to 6 times the face. So if I've got 25,000 times 6, that's 150. I can convert the 25,000 all the way up to $150,000 policy for that child. Okay, so you can convert it to a permanent policy up to 6 times the value of the face. And it is available after policy issue, all right? You have a couple, they have no kids, then they have a child, they can add the policy on, the rider onto their policy if they want to. Excuse me. Now, the other most popular is the other insured rider. It pretty much provides a low-cost term coverage on an individual with a permitted relationship to primary insured. So it doesn't have to be a spouse. It could be a child, potentially a brother or sister, maybe if they live in the household, okay? But it can't be the neighbor down the street. But it can cover issue age is the same as base product. and the minimum death benefit is $25,000 up to the base policy death benefit. So if I have $250,000, my other insured rider can only go up to $250,000. They can't have more than me. But essentially, it basically adds a term coverage for them onto your policy. You can convert that as well. If you want to convert that to a permanent policy, you can take it off and convert it to a permanent policy. All right. Oh, move on. All right, so different sales ideas. Number one, supplemental retirement account, the SRA. We've talked about this, the tax-free retirement. It's designed for cash value accumulation. That is what this IUL is designed to do. So that way we can use it for tax-free disbursements later. That's assuming the client doesn't pass away or access the living benefits, because if either of those happen, there might not be much cash for them to access in the future. But it's, like National Life's puzzle piece: die too soon, live too long, or get sick. Okay, so if I die or I get sick, I might not have the cash, but if neither I don't die or get sick, then I could use the cash potentially in the future. So that's going to be the main reason you sell an IUL, is that cash value accumulation. I know there's going to be living benefits. Like I said, National Life is the originator of the living benefits. So if they decide, you know what, I love the cash, but I really want the living benefits, but I don't want a term, I want permanent coverage, this could be a great option. You can run an IUL based on protection mode, where it's going to make it, a little bit cheaper. I'm not going to say term cheap, but a little bit cheaper than, a maximum funding it, but still gives them permanent coverage, and they get all those living benefits. All right. Another reason could be college funding. That could be, I use my own policy to help pay for college funds for a child, or I get a policy on the child and I use some of their cash value to help pay for college. All right. We have quite a few clients that do this, and then client gets a scholarship or client doesn't go to college, whatever the case may be, then they have a supplemental retirement for themselves where the parent can then pass it on to them. Okay. But you can use it for college funding, taking out those tax-free loans when they go to college to help pay for education expenses. So those are a couple of ideas. So business sales ideas. You just saw these. The only one that's kind of added with the IUL is the premium financing. Now, National Life has a product called Peak Life. Peak Life is $1 million of death benefit or more. A lot of cases that you do premium finance will be that Peak Life, but some of these premium finance cases won't. Some of them will be FlexLife. All right, maybe they're a little older, or it could be they don't have a $5 million net worth. They have a $2 million net worth. So you might not always use Peak Life, but it will allow those clients to use to take advantage of banks, because banks are willing, only with an IUL, to help clients pay premiums on a policy to get more coverage, because they know they will get the cash back because there's no losses. So premium finance IUL is the only one that banks will do that with, and you can use it, like I said, supplemental retirement account, estate planning, legacy planning, a lot of different things, very flexible. And then you just saw these three with the GUL. You can use the IUL for the same thing: funding by cells, key person estate equalization. So I'm not going to break down each one of those. Rodolfo already did, but these are some of the reasons. Number one being premium financing. All right, now I'm going to go to the software real quick. Give me 1 second. Let me get there. All right. Can everybody see the login right here? All right. Thank you. So we're going to go to the illustration software. At the top left, when you log in, here's my login. At the top left is the illustration link. So we're going to click that. Let me close this. Okay. And we're just going to go new illustration. See, FlexLife. Remember, National Life has a captive side of their business. NL stands for no loser. Don't select the NL. No NL. It's only FlexLife. If it says FlexLife or it says LSW, that is what you choose. With the NL, you'll get paid a much lower commission. You'll come back to me. You'll get mad. I'm going to look at it, see that you submitted it, and I said, well, you must be a loser because I told you. Don't select NL. All right, so we're not going to select NL. We're independent, so not NL. NL is on the captive side. So we're going to put in the client. So Bob, that's Bo. Bob, the builder. He's a male. I'm just going to say he's 35. We're going to keep it the rate class standard non-tobacco. National Life, they will offer the client what they deserve. So if you put it standard and they're elite, National Life will offer elite. You don't have to worry about, oh, I need to submit it elite, that way it comes back elite. No, if you submit it standard and it can come back elite, it can come back preferred, it can come back select. You don't have to put what you want right there. You can always leave it standard. So I just leave it standard. I'm going to let National Life tell me they're elite, so that way I can go back to the client and say, hey, you're elite. That's great. That's awesome. More cash value for you. Get them excited, okay? Excuse me. Woo. I'm getting excited. Okay. Owner information. We're going to keep it same as insured. If you have a juvenile here, you might have to put then the parent or the guardian or whatnot. But we're going to leave it as insured, and we're going to come to death benefit and funding. This is where we're going to put in all the information. Tax and compliance, I'm going to ignore, right? We're going to MEC avoidance none, but I'm not going to mess with anything up there. We're going to leave it guideline premium test, and we're going to come down to death benefit. Now, I'm going to run a very basic illustration. I'm not going to show you all the different ways you can run this illustration. We are working on videos for our YouTube page on showing you how to do college funding based on target, retirement focus, protection focus. We're working on videos for that. This is going to be the basic minimum death, max cash illustration. All right. So we're going to select, come back right here on face amount, minimum death, max cash. Oh, that one just doesn't want to stay closed. All right, that's fine. Okay, notice this stays blank because we're not going to change anything in there. Okay, we're not putting in a death benefit. We're going to put in a premium. So we come down to premium. Premium mode, we're going to put it monthly. There's no first year lump sum. We're not going to add any money initially. We're not going to do a term conversion. All we're going to do is come to this X, and we're going to change this to specify amount. And Bob the Builder does really well for himself. So we're going to put away $500 a month. We're not going to do any adjustments. Okay. We're going to go 1-A, let's just say 65, okay? He is going to pay from policy year one, policy year. When you see a number, that stands for policy year. When you see A and then a number, that means age. So this is policy year one to age 65, okay? If you do 1-65, that means he's going to pay for 65 years, and your illustration will look off, okay? We're going to then come down to distribution. We don't have a 1035, so I'm not going to mess with it. We want to solve for income. So all I'm going to do is I'm going to click the down arrow, solve for income, and notice what it automatically does. It filters A66. So client is going to pay from policy year one to age 65, and at age 66, start taking out some loans. I'm going to keep it participating variable. You can change it to fixed, but for now, I'm just going to keep it participating variable loan, okay? Now let's go to riders. So notice here are some of those riders that I was saying. There's quite a few of them, okay? Balance sheet benefit, benefit distribution. Here's child's term if you wanted to add it. Death benefit protection. Notice this is an automatic one. That's why I didn't go over it. It automatically comes with the policy. Guaranteed insurability, waiver of premium. All right, this is not return. This is waiver if I were to get disabled or something. And then here's other insured riders. So I don't usually mess with it unless they ask for something, unless they ask for a child term or then other insured. I don't mess with it. And then down here are all the living benefits, all the ABRs and the summary ages. Whatever's defaulted, I usually leave. But if the client said, well, terminal illness, what about at age 50? What does it look like? I could change this to 50 and it would tell me what it looks like at 50, but I'm just going to leave it 65, okay? Here's the interest rates. This is how you divvy up the money with all the different strategies. Now, what I'm going to do is keep it strategy one. All right, it's the most basic, the most common, the simplest to understand, and it also performs the most consistently. So that's the one I'm going to leave it, but you can divvy it up into these 6 strategies. Again, we're creating a video that will explain how these 6 strategies work. Okay, it will go up on YouTube. We probably won't have a webinar, but it will go up on YouTube. So be on the lookout for that. Now, to look at the summary, we just come over here to the left side to quick view. And we let it pop up. So again, we did $500 a month. Right there, there's the premium. Here's the death benefit, $541,000. Oh, where'd it go? $541,000. So Bob the Builder for $500 a month can get $540 of coverage. Something happens, he passes away. That's what his family gets. And then we scroll down. Notice, like I said, 1-A65. So 65 he pays, 66 he doesn't. He starts taking out a tax-free distribution, a tax-free loan from the policy, and he's projected to pull out $36,000 every year for the rest of his life until age 120. Okay? That's what's projected. So that's the summary page. Now, I want the report. So right here where it says Run Reports, we're going to click Run Report. All right, we're going to let that pop up. Can everybody see this? Let me blow it up just a little bit more. All right. Come up here. Now notice right here it says e-sign later. Because of all this COVID-19 stuff going on, you can click that and it will allow the client to sign it later. We're not going to worry about that right now. Now notice this illustration is 31 pages. Now for those of you who have been doing IUL for a while, it would take you 5 hours to go through all 31 pages. Okay, so what I did was I putting the top 7 or 8 pages that you want to focus on. Okay, so let me pull this up. Can y'all see this PowerPoint? Still? Okay, perfect. If you want to take a picture of this, you can. We will send this to you here after this this webinar. But these are the 1, 2, 3, 4, 5, 6, 7, 8 pages that you would focus on. Now, again, if you're doing the full close that we've taught over the years, you'll go over all these pages. But sometimes you won't. Sometimes you'll need to play an audible, and you'll need to mix it up a little bit. But these are the top pages. So page number 2 is the planned life insurance offers. That's what the title of the page is called. It's essentially the summary. So what does that look like? So we come to page 2. So notice it says my planned life insurance offers, and here's the summary. You're paying $500 a month. If you died tomorrow, your family gets $500,000. If you don't die tomorrow and you need some cash value at age 66, your monthly income is roughly $3,000. Here's the cash value, the cumulative income for your policy at each age, how much money you've taken. But if you become ill, you have terminal, chronic, critical, and here are the summaries. Lump sum per month, lump sum, lump sum. I'm going to be honest, you might be able to explain the IUL with just this page. Okay, National Life didn't have this on the FlexLife 2. Now they have it on the FlexLife. It explains everything. Here's your monthly. Here's if you die. Here's if you don't die and you don't get sick. Here's if you get sick. These are the summaries. Okay. Now notice page 6 and 10 are the definitions. So it's the ABR figures and it's the ABR definitions. These are the living benefits. So what does that look like? Oh, let me go back to it. Here we are. So we go to page 6. Here on page 6, these are the figures that on right here, let me come back to the riders. Here are the summary of the ages. Okay. That is this page. So notice 65, if they were to get a terminal illness at age 65, National Life would give them $474,000 upfront, tax-free. Here you go. Do what you want with it. Heal yourself, go on a vacation, buy a brand new house. It's your money. Do whatever you want, okay? Here's chronic illness, 50, 60, 65, and 70. Here's critical illness and critical injury. Here are all the summary numbers. Now, if they ask, well, what does terminal, chronic, critical, and critical, what does that cover? That's when you come to page 10. Here's page 10. So terminal illness, what is a terminal illness? Means that the insured has been certified, blah, 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 blah. You can read exactly what it means. If they say it doesn't cost extra money, here it is right there. There's no premium for this rider. What's a chronic illness? Chronic illness means, what's a critical illness? It covers aortic graft, blah, 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 blah. Critical injury, coma, paralysis, severe, so you can give them the definition within the illustration and then show them the exact numbers to the dollar of what they would get if they were to get some type of illness, okay? Now, like I said right here, if I change this terminal illness to 60, instead of this being 65, this would say 60. So that is where the numbers come in for you to change it if you wanted to. All right. Next one, the historicals. Okay, now you may not go over the historicals with everybody. But if you have a lawyer or a financial advisor, a doctor, an engineer, somebody who is really smart, a lot of education, and they want to see all the details, then you would come to 16 and 17. Page 16 is the indexing historicals. Page 17 is the index details and allocations. These are the indexing strategies. So let's go to page 16. Just take a look at it. Here are, I'm going to back it out a little bit. Here are the historicals. So this is what the S&P, the Credit Suzy, and the Hang Seng have done since 2000. Okay. Notice anytime there's a negative, there's a zero. Anytime there's a negative, there's a zero. Negative, zero. Because again, no losses with the IUL. We come right here. This is my favorite part. It shows the average. If you look, the last 5 years, the S&P does 9.4. That's pretty solid. This has done 5.7. Not as great, but really good still. But if you look at the last 20 years, 4% with the S&P, this has done 5.4. All because of no losses. Okay. So if they want to see the historicals, they want to see how this thing has performed over time, you come to page 16. Page 17 is, okay, well, how does each strategy work? So here's strategy 1, 9.75 cap, participation rate of 100%. Second strategy, 7.25% cap, 140 participation. So if they want to know exactly how each strategy works, you come to page 17, and then you can show them down here. Here's where we put your money. 100% strategy 1. But it could be 20, 20, 20, 20, 20. It could be 50, 50, 25, 25. You know, that's up to you. Right now, we're doing 100% strategy 1. So again, is this a page you'll go over every time? You know, with it, maybe not with every single person, but you have somebody that's really educated, somebody that really wants to see the minute details, the fine details. This is what you can show them. Okay. Then we have page 26. Page 26 is current illustrated rate. That is the future projections. So we come down here to page 26. Here we are. So like I said, current illustrated rate. And here's what it looks like. You're putting in 500 every month. You've got 541. You do that until age 65. And then at 66, you stop and you start taking out tax-free distributions. Okay. And you can see all the summaries and all the totals. They can see what the death benefit is projected to look like. They can look at what the cash value is supposed to look like. They can see all the details. What's the average interest rate? Roughly 6%. Okay. And they can say, what at age 90 does it look like? Well, at age 90, where's 90? At age 90, you've probably taken out $750,000. You still have $145,000 of death benefit. You still have $53,000 of cash value. We could come here to 104. You've used $1.4 million. Your death benefit's still $181. So they can see all those details. And that's current illustrated rate. Now, we like to show worst case scenario, and that's guaranteed illustrated values, all right? Because not everything's going to be peachy and roses. Not everything's going to be 6-7% every year. So we do come to the worst case scenario just to give peace of mind. So here's guaranteed values. Again, they're still paying $500, but notice it's not really making much money. Okay, it's not really making much money, and it eventually would lapse because we're talking, what this is the market loses every single day for the rest of our life. We're talking financial apocalypse, world financial apocalypse. The likelihood of this happening, not high. The worst was 3 straight years of losing, okay? But I like to show it anyways. Like, look, I mean, even after 10 years, you still have coverage. You still have living benefits. You still got a little cash value. So it's not for nothing. If this was in the 401k, some type of market account, they'd have nothing. They'd have to walk away because there would be nothing left, but there's still something. So we always like to go over this page just to show worst case scenario. Look, even if in the worst of times, there's still many benefits to this policy. Okay, and that's guaranteed values, worst case scenario. And then the last page I want to talk about is page 9, the flexibility of this product. So we got to go all the way back up. If y'all remember the FlexLife 2, this used to be on page, what page was it? Like 30. It used to be the second to last page, and now they moved it to page 9. I don't really know why, but that's okay. Minimum premium right here. So remember, they're doing $500 a month, which is $6,000 a year. The minimum premium for the year is $2,700. So $2,700, I don't know, like $250 something. That doesn't sound right. Let's do some math. 2738 divided by 12, that's $228 every month. So as long as they can pay $228 every month, they keep all the benefits. They're not growing cash value, but they get to keep the living benefits. They get to keep the death benefit protection rider. They get to keep all of those things. They're just not growing cash. So it gives a lot of flexibility to say, oh man, we just had a major hailstorm. I need to replace the roof on the house. I can't do 500. Can you do at least 228? Yeah, I can do 228. Now that client has 262, 272, whatever the case may be, that they can do what they need to at their house, but still maintain their policy. So a lot of flexibility. So we always like to go over that. Okay. And those are the pages that I talk about. Now, like I said, will you go over every single one with everybody? Probably not. But these are, if you're following our close to a T, the way we've shown it over time, these are the pages you would talk about.